I'm going to take just a second here for a public service announcement. I posted this on LinkedIn last night as well. If you were a subscriber on markmeldrum.com at any time in your history, or you're a current subscriber now and you do not have the applied level, you would have received this email. I had a deadline, as it says here. I had a deadline for the applied level. All applied level subscribers up to July 31st are going to get access to all content added to the series in perpetuity. As of August 1st, while new subscribers will continue to get access to the applied level in perpetuity along with any content added, certain new modules that will be added will have an additional fee. And then I say here, an oversight on my part was not informing all current and past markmeldrum.com subscribers about the deadline. While this was telegraphed on YouTube and LinkedIn, several subscribers from the markmeldrum.com family have notified me that they were unaware of the deadline date and have asked me if I can extend the grandfathered in status, and I say, okay, I will do that to September 30th. Only, this is an extension only for those who are past subscribers or current subscribers of markmeldrum.com. You have until September 30th to take advantage of this. So that's what this email is. You would have received this email. If you didn't, I would encourage you to check your spam folder because maybe it went there. And if you are a current or past subscriber on markmeldrum.com and you did not get this email anywhere, it could be that the email address we have for you on file is incorrect by a letter or a number somewhere, or you gave a different email address. I would contact support at markmeldrum.com. Actually, you got to spell out the whole Mark Meldrum. It's not MM, but contact support at markmeldrum.com and say, hey, I was a past subscriber at some point and I never received this email. Because to take advantage of this opportunity, you actually have to click that button. If you don't click that button, it doesn't give you the link to get to where you're going. So you have until September 30th to get this done. And because I've extended this to September 30th, anybody who bought August 1st to September 30th outside of the system, I will extend the same thing. So if you bought on August 10th, let's say, and you say, oh, I don't have the all-in status, you will. I'll just upgrade everybody to that as of September 30th. So check your email, check your spam folder, see if you have this. And if you don't, contact support at markmeldrum.com. For anyone outside of this who says, well, what about me? Yeah, I will make sure that everybody who purchases by September 30th has the same status. However, once we get to October 1st, all that code disappears, okay? It just automatically, it's out of my hands at that point, and then it's over at that point. If you purchase on October 1st, you'll still get the applied level and everything that gets in the applied level, but there'll be newer modules in the future that are added on that you would not get. Okay, there's the PSA done. Okay, we have a lot to talk about this week, but before we head in for the applied level, our next sub-industry, I have time. The financial modeling is going well. I thought it would take up more of my time, so I do have some time. So I'm going to start the next sub-industry. By far, it was cybersecurity in terms of where we were voting. I need a target company now. I can pick one or I can crowdsource this one. I put 5 up here that I don't mind dealing with. I'm leaning towards CrowdStrike. They're not profitable, but if you look at their last 3 years, their loss has been going, if this is the zero line, has been increasing at a very rapid pace. They look interesting. I'm leaning towards CrowdStrike, but there's CrowdStrike, Okta, Palo Alto Networks, Fortinet, and Zscaler. If I had to pick a number 2, I'd be over here. But you tell me which ones that you like, knowing, of course, I'm leaning towards CrowdStrike and Palo Alto. If you're okay with those, we'll just go with those. CrowdStrike being number 1, then you need a backup, something to contrast it with. Going to the financial modeling, Costco this week, we'll be doing the cost schedule. We are finished with the revenue schedule. We'll be introducing the cost schedule. And then from that, we will have our line items all the way to EBIT on the income statement. And we can compare that with the 2024 earnings that we got on Thursday. And we can review the earnings report and make any necessary adjustments while we're there. And there was one number that I looked at and I thought, how can I be so far off? There's something wrong here. And I found a mistake I made. I was calculating some number using an average. You use an average. But then when I forecasted, I did not use averages in forecasting out. It's a big mistake. And I thought, how can I be off so much? Because I calculated the variances, and all the variances are within acceptable ranges. Anything that's based on a relationship of something came in almost spot on. But there was just one line that I looked at, I thought, that doesn't seem right. How could it be off that much? If all my assumptions are right, why is this one off? It was a calculation error. We're gonna fix that error. And then we're gonna review one of the assumptions we made in terms of the inclusion of the number of years in creating an average. We made a judgment call. And now we have the ability to look and say, well, was that the right judgment to make? And if it wasn't, then we should change it so that we don't, compound that mistake for 2025, 2026, 2027 forward. We don't want to overfit to the results, but if there's something glaring, like the calculation error that I made here, if there's something glaring, you fix it. If there was something, a judgment assumption you made that looks like, well, maybe not so, you can make the decision to do that. So we'll do the cost schedule, and then we will review. Hopefully you've all listened to the conference call. You've looked at the press release, and you've listened to the conference call. And here's the nice thing about listening to that call. As you're listening to the call, you'll find that a lot of things, if you've been following along with the modeling, a lot of things and a lot of questions that are being asked, you would say, yeah, that is a good question. You'll recognize the value in these calls now that you're immersed in this process. All right, let's head in. We'll start with the economic calendar, as we always do. A lot to get through, and some things that happened outside of the economic calendar. I don't think we can get through last week without talking about China. They pulled out the guns several times, so I'll spend a whole screen on that. I have France, Germany, the EU, Great Britain, and US on the screen here in terms of the PMIs. I've been asked to include more stuff about the Eurozone. I really don't know much about it, but this stood out. If we're thinking about the next move for interest rate cuts, I don't know that you can avoid interest rate cuts in the EU. I think it's all but a certain thing. Look at these PMIs. We'll ignore the composite. We'll just look at the manufacturing and services for France. 44 on manufacturing, 48.3 on services. Look at the previous, 55, 48.3. That's a big drop. Call this unchanged, 43.9 to 44, still under 50, still contracting month over month, right? So these are still, all of these are still contractions. Going into Germany, ignore the composite. Here's the manufacturing. Here is services. 42.4 down to 40.3. Manufacturing for Germany. That's a big thing there. And services, 51.2 down to 50.6. Expansion, but certainly the second derivative is going the wrong direction. And manufacturing and services here for the EU, 45.8 down to 44.8. 52.9 down to 50.5, going to the UK for manufacturing, 52.5, 51.5, and services 53.7, 52.8. Again, expansion over the month before, but at a slower, I wouldn't say slower rate because it's a diffusion index, so it doesn't really work that way, but at a slower expansion. Coming to the U.S., you have the S&P Global PMIs. They're not... we have a couple of PMIs in the U.S. These are not really the more important ones, but 47 versus 47.9, the expectation 48.5, so it really missed on that, and 55.7 down to 55.4, kind of in line with the consensus, but it was a step down. For Mexico, backwards looking, we have July data here. Economic activity 0.6%, Previous reading was 0. Economic activity year over year for July, 3.8. For June was negative 0.6. Retail sales month over month increased by 0.7. Previous reading for the month before was negative 0.5. And retail sales year over year, negative 0.6. But the previous reading was negative 3.1. So some base effects are falling off. A couple of central banks this week. We had the Swiss National Bank, we had Australia and China. Australia, no change, sitting at 4.35%. Moving into Tuesday, and Tuesday's when the news started coming out of China of what they wanted to do. I got a whole screen for that later on, so I'm not going to include it in the calendar here. We're going to take a whole screen on that one. Tuesday, still in Mexico. This is for September. We have their price index here, mid-month core inflation, month over month, 0.21. The previous was 0.1, so you got to step up on this. Still lower than consensus. Year over year, 3.95, slightly down from 3.98 and slightly below the consensus of 3.97. The headline, 0.09, up from what we had deflation the previous read, and year over year 4.66, down quite a bit from 5.16. We will see. They had a central bank meeting the last week as well. Consumer confidence 98.7 heading into the U.S. here. Previous read 105.6, expectation 103.8, 98.7, and the market said, have you heard what's going on in China? And that pretty much dominated the day. Australia CPI was 3.5, down to 2.7. Remember, on Monday, on the previous screen, at their central bank meeting, they did not lower rates. Well, this is giving them permission at the next meeting. So I have a question here: rate decrease at the next meeting. Wednesday, got to talk about oil. Got to spend some time there. We had big drawdowns in the U.S. Crude oil stocks down 4.47 million barrels. The expectation was for a drawdown of 1.4. Normally, big drawdowns are supportive of prices, but look what happened on the report. Down we came. The Financial Times story about Saudi Arabia potentially abandoning their $100 U.S. oil price target didn't come out till the next day, so you had this drop in price. Even gasoline stocks, the drawdown 1.5 million barrels. The expectation was for, well, I'm going to call it unchanged. And then once the Financial Times story came out, oil continued to sell off. So the expectation here is, starting in December, they're going to begin to increase output, and that their output will be higher by 1 million barrels a day than it is now, higher by 1 million barrels a day by the end of 2025. So every month they're going to increase their production to get there. So you think, well, 12 months of increases, 80,000, 85,000 barrels a month, they'll begin to increase their output. That's only going to put pressure, and that'll keep prices down. And if prices go lower, that's going to put pressure on other countries that need a certain amount of revenue. They're not really too concerned about how many barrels of oil it takes to get there. They need a certain amount of revenue, Russia being the big one. It's got to fight a war. It needs those revenues. So it may start to put more oil out to keep the revenue the same price, which would then cause the price to go lower, which would then cause even more output to come out, which would push the price down. The IEA predicts an 8 million barrel per day surplus. 8 million per day surplus by 2028. So over the next 3 years, it doesn't look like it's going to be a good price environment for oil. Now, this is all based on the best forecast that you can come up with based on what companies say they're going to do. But at some point, as the price goes down, it's going to take some high-cost producers offline. So lower prices will result in lower supply. So I don't know that I'm too willing to buy in to this 8 million barrel per day surplus by 2028, only because lower prices will discipline oil producers. But it is troubling. if you have exposure to any of the oil companies that, especially in the US, that the oil inventory report showing a huge drawdown did not give any lift to prices. In fact, it had the opposite effect altogether. That's rather troubling. That means that the market is looking past this and saying, yeah, but look what's coming. You know, it's an inevitability what's coming, and the price is going to go lower. And then with Saudi Arabia. Now, it wasn't anybody in particular in Saudi Arabia. The Financial Times quoted a source, but they're pretty good at figuring things out by asking certain people for comment. And if there's no comment coming on something, they feel fairly certain they figured out who leaked it, and they're pretty sure it was the prince, not MBS, but his brother that potentially put that out. The Financial Times. So, starting December, production will increase. They've lost a bit of market share by pulling back. They pulled back their output, I think, by 2 million barrels a day to help support prices. And if they start fighting for market share again, you could have another 2014 oil price correction where you went from about $100 a barrel. It finally broke 80 after years being above 80 and continued to go down and settled around $35 to $40 a barrel. And a little while after that, we saw, there's the zero line, you saw that negative oil prices, but, you could see something like that if we have a repeat of that. I don't know that anybody wants to go back to $40 oil, so I think companies would be willing to discipline themselves a little bit better, but you might see 50 based on where we are now, 68, 64. You might see 50 before you see 80. Okay, a lot on this screen. We're now into Thursday. Durable goods for August came in zero. Came in flat, no growth month over month. Previous was a big month. The expectation was for it to be negative, so that actually beat the consensus. Taking out transportation, up 0.5. The previous month was down 0.1, so controlling for that, you do have something there. And taking out defense, negative 0.2. Previous was 10.3. GDP growth, our final look at it, not much changes here, 3%. The expectation was 3. The GDP price index, quarter over quarter, 2.5. The expectation was 2.5. Nice step down from Q1, which was 3. Core, 2.8. Expectation, 2.8. Step down from 3.7. That is fairly good. Corporate profits, 3.5. That's a big jump from the last read we had, or the consensus of 1.7. Q1, negative 2.1, so 3.5. Real consumer spending, very solid, 2.8. Q1 was 1.9. And the job market, initial jobless claims, 218. That is fairly low. Continuing jobless claims, though, have stepped up by 13,000, 1,834,000 versus 1,821,000. Here is the Mexican Central Bank interest rate decision. Was 10.75. They did cut to 10.5. There's a 25 basis point cut. The peso has been hanging in around 19 and a half, really 19.6, maybe 19.7 you see, but hanging in around there. It's not really going very far. Swiss National Bank, 25 basis points. That's their third cut. They're down to 1% on the overnight rate. Their CPI for August came in at 1.1%. And a statement, I put in quotes, a statement on the decision. Further rate cuts may be necessary to stabilize inflation within the range of price stability. If we look at the Swiss National Bank's forecast for CPI for 2024, they're forecasting 1.2, 2025 0.6, 2026 0.7. So significantly below the 2% upper bound. Their target is 0 to 2%. Most economists think if you're below 1%, you're probably already in deflation, which is a terrible thing for a country to be in, especially one of the more indebted Western nations. No government at this point, Canada, US, wants to see deflation, because with deflation you have lower GDP, and if you think of GDP as your tax base, you have a lower tax base, you have lower revenues, your situation only gets worse. But if you have inflation, your GDP is higher, so your tax revenues are higher even without higher tax rates, but your debt, if you owe $1,000, you owe $1,000. It didn't get up. You can deflate away the debt. But deflation would inflate the debt. That would be a bad thing. So there is some solid belief here that the Swiss National Bank is going back to the zero line. I've held for quite some time the belief that the U.S. Will have no choice but to head to the zero line, because deflation is probably the backdrop that we've always had. The inflation we had was, I think, very pandemic related, but after the great financial crisis, for that whole decade after that, deflation was the biggest concern of the Fed. So with deflation, if the economy is not going to produce inflation, the central bank has to do it. It has to be a monetary phenomenon, which means you increase the money supply. It's all you can really do, is increase the money supply and hope that you get inflation. Otherwise, that debt becomes a huge problem. Well, we're probably heading back to the zero line over here. Japan, new Prime Minister Ishiba. There is talk and there is action, and he has a certain talk. Two main points. He endorses the Bank of Japan's policy of raising rates, and he has voiced concern about yen depreciation. Whether he'll actually do anything or encourage anything to be done is a different thing. You can say, look, when I'm in office, I'm going to do this. You get in office, your advisors come in and say, look, here's some things the public doesn't know, and we're going to tell you these things. And you hear them and you think, okay, I clearly can't do what I want to do then. I can't do what I promised to do because I didn't know all of these things, right? So, he may be saying, look, we're only hurting pensioners with these low interest rates, and we are a funding currency, which makes it hard to defend our currency. Let's get interest rates up. When he gets in office, somebody may pull him aside and say, look, with the level of debt we have, things are worse than what you think. We can't afford it. You can't do what you said you want to do. So there's talk and there's action. This is talk, and sometimes you talk to get votes. Right? Look at what Trump is saying. I love crypto. I love unions. I love this. I love that. No tax on this. No tax on that. No tax on so. He's promising everything to anybody who wants to hear it. Right? Because what he's saying is to get the vote. Not that he actually means to do any of that stuff, but he'll tell any room what they want to hear to get the vote. This could be something like that. Look at the yen. It had a little bit of a run up before. It got to 146.25, and there's the new prime minister announced. Oh, he wants to raise rates. He doesn't like the weak yen, all the way to 142.20. That is over 15 hours, 146.25 to 142.20 over a 15-hour time span. But you could say, well, it really wasn't 146.20. It was less than that. It ran up in anticipation of the other person, the woman, potentially getting the nomination, and nope. And a massive correction very, very quickly. That could also have supported the peso in the end of the week, being fairly weak, is that the interest rate differential, if the expectation is, well, Mexico's going to continue to cut their rate, Japan's going to continue to increase their rate, that differential is changing. It might be time, rather than borrowing in yen and investing in another country, to borrow short in yen and invest long in yen. So rather than an intra, and I'll write that out, rather than an intra-market yield curve trade, intra-market means between markets, and you're doing something at the short end of the curve. So you borrow in yen and you invest in peso because you have, call it 10% here, and let's call it 0% here. But if you think that rates are going to be dropping over here, and rates are going to be increasing over here, rather than borrowing here and investing here to get the interest rate differential, you would borrow here and invest on the long end of the Japanese yield curve to get duration. You might get maybe 20, anywhere from 15 to 20 on your duration. You'll make a lot more on a duration trade if in fact they raise rates and the long end increases than you would on an interest rate differential. And you can lever that up as well. So you may get more of an inter-market carry trade rather than an intra-market carry trade. Maybe that's why the peso was, again, hanging around 19.5 to 19.7, not really doing much. All right, into Friday. Here's France. We've already seen all the PMIs. Here is inflation for September. Look at this, negative 1.2. This is the headline. Inflation, this is month over month. Inflation rate month over month, negative 1.2, and year over year, 1.2. I didn't see throughout the week inflation readings from any of the other countries, but I thought I would show that. You've got a lot of weak PMIs, which would support a deflationary or massive disinflationary backdrop, which we're seeing. Why we wouldn't book 100% probability of a rate decrease coming out of the EU, I don't know. That seems like a given at this point. Canadian GDP for July, up 0.2. Previous read was 0. The consensus was 0, so that's kind of a nice little surprise. However, August takes it away. The previous read was 0.2 and saying, no, let's go to 0. So give it on one side, take it away on the other side, right? I still expect the next Bank of Canada meeting to give Canada another 25 basis point cut. Coming into the U.S., I don't know that there's any surprise here on PCE. It tends to follow CPI. 0.1, previous reading was 0.2, expectation was 0.2. This is the core. There you go. The price index, the headline month over month, 0.1, expectation was for 0.2. Year over year, for headline 2.2, down from 2.5. The core, that's the only one that you can really point to, but it came in as expected. I expect this trend to continue. I've said this before. We have a technologically deflationary backdrop to the economy, and that will continue. I don't know that you could say that there is an inherent shortage of anything in Western nations. If you rank all the countries in terms of GDP, and the most GDP on the way down, U.S., obviously China. I think it's a tie between Japan and India, I think. But if you rank them all the way down and say, okay, well, let's take 80%. There's a whole bunch of countries under here, by the way. You got an 80-20 rule here. You take 80% of global GDP, and you go to any of those countries, and you walk into any store anywhere. There's no shortage of food. There's no shortage of goods. There's no shortage of clothing. In fact, there's an abundance of that stuff. There's no shortage of anything. We don't live in a world of shortages, at least not in the GDPs that matter. In terms of creating inflation. The bottom, even though there's a lot of countries down here, they're too small that even any massive increase in their economies in demand could not have much of a global effect overall. So really it's the big countries. There are no shortages. And technology does promise to make lives cheaper. That is the benefit of technology, right? So I do think that deflation is going to be the bigger problem going forward. This inflation, clearly we know what the source of the inflation was. Personal incomes month over month for August up 0.2. Previous was 0.3. Expectation was for 0.4. Personal spending 0.2. Expectation was for 0.3. Previous was 0.5. So personal incomes growth, but not as much as was expected. Personal spending growth, but not as much as what was expected. At this point, well, let me get to Michigan Consumer sentiment, and then I'll say something here. Sentiment 70.1, up from 67.9. The expectation was 69.7, so the sentiment came in. It's made up of two indexes. The expectations, what do I think the future is, and what do I think it feels like today? It feels better today in September than it did in August, and I think the future is going to be better from my perspective in September than it was in August. Let me say something about U.S. recession and global recession. It kind of looks like Europe is probably in a recession, or close to it. I don't know that that's avoidable. For the U.S., it's a different country. It is extremely rare that it falls into a recession because of endogenous conditions. Endogenous means nothing external happens, no external event happens. It just is, the weight of all the spending, the fatigue of the spending, the, companies that are adding efficiency by laying off people here or there, that it slowly tips itself into recession under its own weight. Very rare do recessions happen endogenously. There is usually some exogenous event that occurs. And it usually tips an economy into a recession when the economy is already in kind of a slowdown mode. And the slowdown mode is usually created by the Fed raising interest rates to constrict the use of credit. So an inverted curve will slow down an economy. The Fed has already started to lower rates by noticing that the economy is the bigger thing to worry about, that it looks a little weak. Let's start lowering rates and the curve uninverts. But you have a weak economy, and these rate cuts do work with a lag. That if you get an exogenous shock with a weak economy, that's what causes the recession. An exogenous shock with a strong economy may lower it to a weak economy, but not a recession. But in a weak economy, some exogenous shock will do that. Well, we have a port workers strike coming up. The longer that lasts, the more that may cause a drop in GDP. You have certainly increased activity and tensions and finger wagging going on with Israel's latest move against Hezbollah. Iran is now saying, we vow revenge, but their vows are, I don't know. They seem more afraid of starting a war than anything. It's kind of like that kid from across the soccer field. Remember when you were in school that would call you names, but when you walked up to him and said, what did you say? Nothing. But you get 10 feet away, he's calling you names again. Turn around, what did you say? Nothing. You remember that kid, right? Yeah. That sounds like, kind of sounds like what Iran is like right now. What did you say? Nothing. So I don't know that I would think a recession is going to happen. However, I will say this: the economic conditions are ripe for an exogenous event to actually cause something bad. But exogenous events are unforecastable, they're unpredictable, they're random. Who knows? So I don't know that I would get out of whatever I'm in and take a big short position and sit around and wait for an exogenous event. Many exogenous events are headed off before they actually happen because you have people who are motivated to make sure bad things don't happen. If I had to point to any one thing potentially being a catalyst, it would be Iran actually, when Israel turns around and say, what did you say? They actually say something. You heard me. And, push them and start a fight. That would be an issue. I just don't know that they have it in them to do it. Okay, let's have a look at our money market and capital market rates and yields. The money market still continuing to suggest that there is more than 25 basis points, or 2 times 25. The probability for the 50 is increased slightly week over week for the next meeting. And I'm hearing a couple more analysts saying we expect another 50. I don't know. I was wrong last time, so I don't know if I'm going to take much of an opinion here. Longer end of the curve, feeling that we've done a lot. Let's hang out here for a while. So I think TLT is probably going to be range bound for a while. I have calls on my position that are sold for October. I don't plan to close them. I don't think TLT gets there. So it's this will be range bound, I think, until we get a little bit more clarity. We get jobs report on Friday coming up. We'll see that on the next screen, what the economic calendar looks like. That'll be, I think, an important event for determining where the direction of long rates go. The curve is firmly uninverted. We have 20 points on this. I don't see it reinverting unless you get a port workers strike on Monday night that lasts 3, 4, 5 weeks. A significant amount of containerized goods and food come in through those ports. It could cause shortages and inflation and cause the Fed to potentially be on hold for a while at this rate, which might cause a bear, the 2 year to come up, not a bear steepener, the 2 year to come up. And if it does come up above the 10, you may reinvert, but I don't think that's really viable at this point. I think we're firmly out of inversion, up 20 points. Canada 4.6 has an upward sloping capital market curve. The money market to capital market's still inverted, but the U.S. is under 100 now. 699 days on the inversion for that one. This will take a while to uninvert because it's all about the 3-month rate, which will be tied very tightly to monetary policy. And curvature continuing to flatten out, negative 19 to negative 15. January was negative 123 basis points. Now we're negative 15. The balance sheet running off nicely here. The SOMA down 17.6 billion to 6.55 trillion. I don't know that we'll see a 5 handle on this before they have to start increasing security holdings again. The balance sheet itself runoff there's lower by 29 billion, so a net decrease in the balance sheet beyond the securities decrease of 11.4 billion. And here again, this is rather curious, is why the safety of money market funds? What's going on? Look at the increase, $120 billion going into the end of last week. Now we could say, well, it's a quarter end, call Mondays the real quarter end, but okay, we have the weekend coming up. Maybe it's a lot of positioning going into the weekend so you don't have to do it Monday. That would make sense. It's consistent with what we'll see in the reverse repo, is maybe it's just positioning and we really won't know until, next week when we get into October, get past the end of a reporting quarter. Retail up 7.8 billion, institutions up 113 billion, up on all of them. If we believe that, look, central banks around the world are in a rate-cutting cycle. China just exploded with their stimulus in every measure that you can think of. We'll have a look at that. Isn't this bullish? And if it's bullish, shouldn't we, what are we sitting in money market funds that are earning 50 basis points less now than they were, a month ago? Shouldn't we be grabbing some of this equity, some of this duration on the long end of the curve? But it keeps going up, so it's questionable. What do you need the safety of the money market for? Just to continue on a moment from that last thought, you have $6.42 trillion in money market funds. I'm not one of those people that are going to say we have $6.4 trillion of money on the sidelines. To say that is to suggest that the assets under management for money market funds should be zero. Right, if you say that you have 6.4 trillion on the sidelines waiting to come into the market. money market funds always have a balance, always have assets under management. It never goes to zero, so you don't really have 6.4 trillion on the sidelines. You have some money in money market funds above what would be normal, but it never goes to zero, so we can't say 6.4 trillion. Number two, you don't know it belongs to the equity market. It could belong to the bond market. Nobody knows where that money belongs, so I will never sell you on the idea that you should be bullish on stocks because there's 6.4 trillion on the sidelines. That would suggest, again, that assets under management for money market mutual funds should be zero. It is not. So it's just why the increase? Why the increase is going on when markets are, well, they're on a tear. Commodities are doing well. Everything seems to be doing well. Duration has been doing well. Why the safety? That's all I'm asking. Why the safety? November 7th, FOMC, 39 days away. It's going to be a big day again, right? Every meeting's a big day. 50 basis point cut, 54% up from 50%. Slight increase, but it's leaning more towards 50 basis points. Going out to December, not much of a change here. The 4.25 still hanging out at 50%, and the odds seem to have shifted down to even more rate cuts, 28.3 up from 23.7, and ending at 4.5, probability dropping 21.9 versus 26.3. Being that we're almost at December, let's just jump ahead and we'll put December of 2025 in here. Look at the range of outcomes here. I think this will be the more interesting one to watch, and I think we'll just drop this one. Well, this one will drop off eventually at the once we get to the November meeting. And I think we stop with the TGA, reporting the TGA. It was interesting when you had a debt ceiling and we watched the TGA account, run off. And when it would be out of cash, but it's not a problem right now. It's going to hug very closely to 750 billion. Every week I look at it, I go, this is boring. There's nothing to say about it. It is as expected, so I'm going to drop off the TGA. Why bother? Let's look at December. Look at the distribution. I found the median where you're at 50%. It's 3% by the end of 2025. That's the upper range. That's 2.75 to 3. We're at 4.75 to 5, so that's implying 200 basis points of rate cuts in 10 meetings, or 8 rate cuts over 10 meetings. I think that's reasonable. I look at that 3%, I think, yeah, okay, I think that's reasonable. What I don't think is reasonable is 3% by the June meeting. I don't think that's reasonable, but by the end of next year, I think that's reasonable. I don't think there's a play here on ZQ. I think that's probably reasonable. 3%, and then you have some probability of it being more, but with this kind of distribution, I don't know that listing off all the probabilities matters more than the median. The median to me seems reasonable. Give it another year, and the Fed will be talking about the threat of deflation, because you have inflation running under 2%, and then it shoots up, and then it's coming down. Do you think it's just going to do this? It shoots up, it's going to shoot down before it comes back up. Well, that is going to be where you're going to have big rate cuts, because it's not just going to stop at 2% and go sideways. The summary of economic projections has it doing this. Here we go, we're home. Not going to happen. Another thing I want to point out here, give it, from 2025, sometime in 2026, the Fed will start talking about its inflation target, that maybe it should be 1 to 3%. It'll start walking up its inflation target. One way to help deal with the debt is to inflate it away. Rather than 2%, have a 3% target. Because if you have real GDP of, let's say, 2%, and you have inflation of 3%, you pull out a 5% nominal GDP, which means tax revenues will increase by 5% without increasing tax rates or increasing taxes on anything new. But if you have a 2% rate, and let's say you have only 1% in inflation, you have 3% growth in tax revenues, not 5% growth in tax revenues. Well, that starts to make the debt more unaffordable. The probability of tax increases, and if more taxes increases at that point, and you're not closing a deficit. So one of the tools that the central bank has available to it, if it wants to avoid the zero line, is to raise the inflation target. And if it's credible, the market will believe it and begin to price that in, thereby creating the very inflation that they wanted. I'm going to go ahead and say that now, that wait till this inflation thing is over and that they can declare victory. And then I'm pretty sure they'll start talking about raising the inflation target to help avoid deflation, and at the same time to help finance the sheer amount of debt. If you have inflation, you can inflate it away, right? But given the governments that we have these days, if you have increased tax revenue, they will not see that as an opportunity to manage the debt. They'll see that as an opportunity to run bigger deficits. Revenues are increasing. We can spend more today. We will grow our way out of this, and none of it will work, and they'll ruin the opportunity they have. Yeah, so this we'll drop this off after the November meeting, and then we'll focus on this. And I think the important metric here is, where's the median on this one? We'll get rid of the TGA. By the way, the TGA is down 60 billion, but we'll get rid of the TGA. There's no information there. New York Fed the effective federal funds rate, 4.83%. We know that. That's not going to change till November. Reverse repo up 97 billion to 436 billion. What gives? Again, I'm going to go ahead and say, like I said on the last screen, I'll give it to the end of the month because, okay, Monday really is the end of the month, but in front of the weekend, why not get the work done now? Companies do have to report, and many of them have a September 30th closing date on their end of quarter. So positioning more money into cash equivalents makes your liquidity positions look better, makes your debt ratios look better. It's window dressing for the end of the quarter. Maybe that's what's going on. So I'll reserve judgment until next week. Next Friday, if I'm right, I should see a large drawdown in money market mutual funds and a large drawdown in the reverse repo. But next Friday, if these two things increase again, we got to say, what is going on? Money is looking for safety. What is going on? We can't ignore that. Reverse repo plus reserves minus ample, 1 trillion at 40 billion a month, 27 months. But we have rates coming down now, so the MBS, the prepayments on MBS may increase. So this actually may be running off at a faster rate than 40 billion. Because they're not rolling them over, so as they get their prepayments. If the PSA speed increases, and we're seeing it with mortgage applications being elevated for how many weeks now, if that continues on, probably you might have 42, 43, even 45 billion running off a month right now. What's on the calendar this week? The more important ISMs this week. ISM manufacturing, we get in 2 days. This is the PMI. ISM purchasing managers get in 2 days, and services in 4 days. These ones seem to get a hell of a lot more attention than S&P. Let's watch total vehicle sales for the U.S. We get that in 2 days. Tuesday, and this is a big jobs week. Tuesday, JOLTS. Wednesday, ADP. Thursday, initial claims, and let's keep watching the Challenger job cuts. Friday, the jobs report, U.S. only. Canada is next Friday. And we have, so far, as the week unfolds, more names are announced. But so far, here's what we got. Monday, Bowman and Powell. Bowman is the one who dissented, by the way. The governor that dissented said, no, I only want to go 25, and I want to be on the record as saying that. Tuesday, Bostic, ×2. And in case you didn't hear him, he'll say it again Thursday. Bostic, Cook, Barkin, Collins, and Thursday, Bostic and Kashkari. Okay, I got to say something here. I reviewed my market outlook from last week, and for some reason this screen didn't make it in, but I remember narrating it. I guess I just didn't put it in the timeline. But what hurts most is nobody said anything. It wasn't there and nobody missed it. Nobody cares. Nobody cares. That's the message I get, is you don't really care. Anyways, what do we got here? Real rates, hardly any movement there, and break-even rates, look at that, hardly any movement here, nothing to talk about. When we get to the OAS, so I'll say the same thing, there's nothing to talk about here. The Fed funds futures, very little change in these, 95.175, 95.18. Well, this is October, we wouldn't expect any change. 95, 94, 95, 96, 95, 56, sorry, 96, 56, 96, 57, like hardly any change at all. Q4 suggesting 78.5. That is a 50 for November and a 25 for December. I'm not at the 50. I wasn't at the 50 the first time and it went 50. Michelle Bowman wasn't at the 50 either, so she must have been listening to me. I don't know. We'll have to see about the jobs report and the data coming in. I'm data dependent. That's what I'll say. I'm data dependent. I'll make up my mind when it comes in. Q1 39, Q2 37. So by mid-2025, 156 basis points by June 30th. That is 6 cuts in 6 meetings. If we say, well, 156 at 25 each time, that's 6 cuts or 6 meetings, I think that's fair. I think that's a fair number if you go at that pace. TLT down 0.35% for the week. We'll call it flat. SPX up 0.62. Again, call that flat. Implied volatility, the percentile pretty much faded away. 0 percentile, which means in the last 13 weeks, all observations of implied volatility have been higher. IV is way down at the bottom of this chart. You can't see this little line, but we're way down here. So not a lot of money in the premiums right now for doing anything. I have made significant changes week over week to TLT. So head over to markmeldrum.com if you have the applied level, and the new positions video is up for Friday, which outlines the positions I've taken in TLT. Mortgage rates going to be sticky here. Trying to get a 5 handle on that's going to be a little bit of work here, but all the way down to, call it 6%, down a basis point. The U.S. 10-year Treasury increased by 6 over the same period. The spread decreased by 7, 229. Coming through in agency here, not so much in annually, but look at ABR up 4.4. Those people who were short have been covering, pushing that price up. That thing is working out nicely. The synthetic I have on that, not synthetic, risk reversal I have on that. IYR down, XLU 0.43. I'll say more about XLU in a minute. Housing mixed. Housing is mixed on this one. House price index was up 0.1% month over month. Case-Shiller 0%. Month over month, 5.9% year over year. Mortgage apps up another 11% for the week ending September 20th. Building permits up 4.6%. And this is sort of mixed here. New home sales down 4.7%. Pending only up 0.6%, and nothing to see on OAS. Look at this, hardly anything going on. Up 16 on Triple C. Let's look at XLU. Data centers are just a huge draw on energy. So XLU has been performing very well. If we look at the XLU implied volatility, this is 52, 26, and 13. You have very nice implied volatility here. And if we look at the money, an $80 put, 49 days, pays $1.81. I don't think this data center story is ending anytime soon. I don't know that AI is there yet. I don't know that it is ready for prime time. But you can't be a significant company and not be doing something about this. So it is going to continue. I think the demand for energy from utilities is going to continue. Primarily data centers, because you think, well, it's only one data center. The amount of energy that one data center takes is astronomical. It's huge. And the U.S. seems to be almost the center of gravity of the world for AI training. So, America is going to have to produce the energy that powers the AI revolution globally. XLU, I think, is not done doing what it needs to do. Okay, Dockworkers strike. Trying out a new way to present information. I was writing this out on the screen. I thought, why am I writing this out on the screen? I could just type it out in Excel, in PowerPoint, and then just screenshot it and bring it in here and then just write over it. Dockworkers strike, U.S. East Coast and Gulf ports. There are 14 ports, 25,000 workers. It's more like 50,000, but the number 25 given is in terms of full-time equivalent because there are part-timers in there, but 50,000. Monday night at midnight is when they can strike, and the union is saying we will most definitely strike because they're not getting what they want. How damaging can it be? 68% of all containerized exports. This is by value. 68% of all, by volume of containers, it's about 50%. But by value, it's 68% of all containerized exports, 56% of all containerized imports. This is going to significantly increase shipping costs because you're still going to ship this stuff. You're just going to reroute it to West Coast ports. So you're going to have to incur longer journeys. And if you've been through the Understanding Ocean Shipping video, you know that if you have longer journeys to make, it lowers the amount of ton mileage available, which lowers the amount of supply, which raises container rates and raises shipping costs. So if they do strike, look for increases in shipping costs. Rerouting to the West Coast ports, but the West Coast ports can't handle it all, nor can the rail system from those ports handle it all. So some stuff is simply not going to get into the U.S., but my understanding is some companies have already begun rerouting their product to West Coast ports. Beyond the dock workers that would strike, it would affect another 100,000 workers because you have warehousing, you have trucking, you have customs, all of the support around these ports would be affected as well. So if you do have a strike at midnight, initial jobless claims the next week is going to be significant, and if it lasts for a while, the jobs report for November could be pretty ugly. Well, the one that we get in November for October could be pretty ugly. Would reduce GDP by 4.5 billion to 7.5 billion per week. That is a loss of 0.1% of GDP. So if GDP for the quarter would have been 2.9%, every week would be 2.8%, goes another week would be 2.7% in terms of growth, because this would be decreasing the level of GDP, which is going to affect the growth rate. So it is going to have an effect on the U.S. economy if this does happen. The last time there was a strike, it was on the West Coast. This was back in 2002. It went on for a number of days. I forget how long, but Bush ordered them back to work. Biden has said, or the Biden administration has said, we're not going to do that. There's the not going to do it, and then there's the reality of the election coming up, right? Yeah, rock and a hard place. You know, Biden could order them back to work, and Harris could distance herself from Biden on that one and, you know, not affect the economy, and Harris can escape unscathed from the union side. But that's kind of tough to do, to throw the old man under the bus twice. If you don't do something, you risk a long strike and the economy being affected going into the election, and Trump, you know, saying, I would have solved that strike, you know, before it even happened. I would have taken care of it. It would have been beautiful like you've never seen before. Everyone would be talking about, you know, that kind of stuff, right? What do they want? Look at West Coast wages, $54.85 an hour. This is not counting overtime or benefits. That's $54.85 an hour, increasing to $60.85 an hour in 2027. East Coast makes $39 an hour. and they're asking for a 77% wage hike over 6 years. That's $5 a year over 6 years. That would bring them to 69 US, and that would be on par in 5 years of where the West Coast would be. This is the big one here. This is just brutal. They want a complete ban on the automation of cranes, gates, and container movement for loading or unloading. Anything that removes a job, they want a complete ban on. Even a gate that opens up and closes down for a truck to get through. You know, a truck pulls up to a gate, the gate opens, you drive through. One port put an automated gate in, and the union had a conniption fit. I mean, just had a fit about it, because you need somebody there to press the button to lift the gate for the truck to drive through, and then to press the button to lower the gate until the next truck shows up. Then you press the button again to raise the gate. Why would you automate that when you could have somebody sitting there for $40 an hour pressing that button to raise the gate when a truck shows up and to lower the gate? Even that, we must have somebody sitting there, says the union, as they take off their shoe and they pound the desk in their most Khrushchev moment. This, I think, is just a ridiculous ask. I think that's a ridiculous ask. Yeah, get your wages up. I agree. If West Coast is getting that much and you're only getting 39, okay, that's a fair ask. But come on. I mean, come on. Have something. Although this is part of the art of negotiation, right? When you go into the negotiation, you may want three things, and you want those three things, but you don't go in asking for those three things, because you're going to have to negotiate some of that away. You go in asking for six things. You go in asking for some things you do not want, and you make it a big deal, because you're willing to back down on that without having to back down on the other stuff, right? So it's very common going into negotiations to say, okay, what do I care about? What do I not care about? Let me go in. And then your job is to figure out, well, of the things the other side put forward, what do they not care about? Let's figure out what they care about and what they not care about. I don't know so much that the union cares much about this. Maybe they do, I don't know. This just seems like something that they would negotiate away in exchange for wages. USMX, this is the U.S. Maritime Alliance, has offered 40%. The ILA is the International Longshoremen's Association. That's the union. This is management. Management offered 40%, not 77%, and isn't saying much about this. They're saying we'll extend the current existing wordage or verbiage that we have about automation. We'll extend that going forward. But they, I don't know that they're willing to write out the words an all-out ban on everything. So look at the trade-offs that you have here. If you have the strike, it is going to hurt the U.S. economy, but it is the U.S. workers' right to strike. And if you order them back to work, you are denying them of their right to strike. You have to balance this. However, management is mostly foreign-owned companies. You order them back to work, you're kind of siding with the foreign-owned companies and the U.S. economy against the U.S. worker. Now, you got a tough trade-off here if you are the administration. Now, he's not running for re-election, so Biden could go ahead and do what he wants, and Harris can distance herself from this. But think about the optics on this. Management is mostly foreign-owned companies. The workers are U.S. workers. That seems like a clear-cut choice, side with the U.S. workers, but that could hurt the U.S. economy, which is a much bigger group than the workers that are striking. And I've said this many times in the past, a strike is a sacrifice of the many for the benefit of the few. It is the most socialist thing that you could ask for, is a strike. I think all strikes should be banned. And if you don't reach an agreement, you go to binding arbitration, period. Nobody wants to be out of a job, but people want to be treated fairly. Negotiate, but don't hurt everyone else around you and throw a fit because you can't get what you want and put other people out of work because you didn't get what you want. I think that it is a sacrifice of the many for the benefit of the few. And if I were the president, I would have already said there will be no strike. There will be no strike. Go ahead and bang the desk with your shoe all you want. There will be no strike. And I wouldn't play favorites. There'd be no strike anywhere. I would shut down every strike immediately. I'd find some way. I'd shut down every strike and say binding arbitration. In fact, I would probably want to pass legislation stripping unions of the right to strike and replacing it with binding arbitration, because a strike is an economic weapon of mass destruction held by a few people who use it to extract what they want. What is that? Racketeering? Yeah, racketeering. Imports were running 10% higher leading into this. Most Christmas inventory arrives in August and September, so most Christmas inventory is already here. If you've ever been to any of the trade shows for the retail group, the trade shows are usually in July and August, and it's an ordering show where you place your orders, and your orders are usually delivered end of September, mid-October. So they're already, all that Christmas stuff is in the country already. I don't think you're going to see real shortages of that. So I don't know that you're going to get a lot of price pressure. Less price pressure than economic weakness from a prolonged strike, though it's more likely to lead to economic weakness than it is to inflation. So if there is a strike, the belief is that that almost cements a 50 basis point cut in November, and the longer the strike goes on, the more likely you're going to get a 50 basis point cut. It's a tough decision to make. U.S. workers or foreign companies? U.S. workers versus U.S. economy. What would you do? Okay, let's look at China. There's something here for everybody. There are moves to promote more disposable income, to support consumption, to support home prices, creating a wealth effect, also to support asset prices directly, for credit expansion, to support consumption and investment, and some growth-focused actions to support consumption and investment as well, issuing quite a bit of bonds to get this done as well. Let's go through what they're doing. 7-day repo rate cut by 20 basis points. The rate on medium-term lending facility cut by 30 basis points. Loan prime rates cut by 20 to 25 basis points. For the property market, 50 basis point reduction on existing mortgages. Let me explain that. You got a mortgage. You're paying your payments every month. You get a 50 basis point reduction on your existing mortgage, not new mortgage rates coming in. This is not for new. This is everyone who's got a mortgage. On average, let's cut those rates 50 basis points. That will leave more disposable income in the hands of households, which should support consumption. 15% minimum down payment on all types of homes, down from 25%. So you can enter the property market sooner. You only need 15% down payment. That should support, or at least the belief is it's going to support home prices, right? There's announcements, there's saying something, and then there's action. So this is what they're saying. Will the consumer take up the challenge and actually say, okay, well, it's 15%, I will buy now. Will it actually result in something? That's a different story. The stock market, just in case that was left out, over the last 10 years, that stock market has gone straight down. 500 billion yuan, which is about 70 billion US. 500 billion yuan swap facility for funds, insurers, and brokers to provide liquidity to buy stocks. And 2 more rounds of 500 billion are possible. 300 billion yuan in the PBOC loans at 2.25% to commercial banks to help fund other entities' share purchases and buybacks. And some discussion of a stock market stabilization fund was also mentioned, that if stock prices keep falling, maybe the government will buy it all, right, to support prices. Well, this will create a wealth effect. If you can push that stock market up and push those prices up, you can create capital gains, and maybe some of that will be converted into property or into consumption spending. Also, if margin loans are cheaper to get, it will bring more money into the market to put asset prices higher. The higher those go, the wealthier you feel, the more you're likely to spend a greater proportion of your income on consumption. 50 basis point cut, not curb, but cut in the reserve requirement. So this is all banking is reserve style banking, where you get a deposit of $100. You must leave $10 in reserves at the central bank, and you can lend out 90. Well, 50 basis point cut adds 1 trillion yuan for lending. It's another 142 billion that can be lent out, and signal that maybe there'll be another 25 to 50 basis points cut in the reserve ratio later this year. And that supports credit expansion, which supports both consumption and investment. You can borrow money to buy a vehicle, or you can borrow money to buy a house. On the fiscal side, money for kids, 114, the equivalent of it's in yuan, they're not getting US dollars, but equivalent of $114 US per child for families with 2 or more, but not the first. So if you have 2 kids, then you qualify for this, but not the first one, only everything after the first. So obviously it would be for 2 or more, right? Money for the impoverished, more money for them than for kids. Subsidies for consumer goods replacement program. I'm not quite sure what that means. I guess if you're buying a fridge because your old fridge is done, maybe there's a subsidy to help you buy the fridge. And for business equipment upgrades, help for local government debt up to 1 trillion yuan into the largest banks. Going to be issuing 3 trillion yuan in bonds to fund these measures. Keep in mind, they'll eventually have to come from somebody. Government is going to issue bonds, right, to help promote the common prosperity. The most successful people in China are probably well aware that, you know, when they go to pay this back, they're going to get it from me. They're going to get it from me. So at the margin, this may push more capital out of China, because money does leave China at a rapid pace. Just go to Dubai and have a look. So this may, at the margin, push more money out, much as it would do in more Western nations. The U.S., I think, Canada is already going on, is if you have the specter of higher tax rates, taxes usually are only on successful people. Successful people are expected to pay a disproportionate share, not their fair share, a completely unfair share. Well, that does chase capital away. So you may have something like that going on there. But this has done a lot in certain parts of the market, especially in the commodities play. We'll look at a couple of commodities on the next screen. But I don't know that you went through last week without noticing this. If you had any exposure to any miners or any commodities, you probably looked at the reaction going, what's going on here? And you look around and you see this going on. There may be more announcements. They're trying to support their 5%, which brings up sort of a question. Governments lately have become a greater and greater part of the economy. If governments retreated back to their role they had 20 years ago, what would the economy be today? The amount of government support the U.S. economy has needed, and the amount of spending per GDP that the government now represents of the economy. And you have this going on in China, that to hit your 5% target, you have massive spending and massive stimulation that has to go on from the government. Kind of makes you think about, well, what is the real state of everything if you didn't have the government doing it? So 2 big beneficiaries last week in the commodity space, copper and aluminum. Precious metals, not really. Up week over week, but nothing much to talk about. Gold, silver, platinum, palladium, not much to talk about. Copper, big move here, 5.7%. This was the first announcement over here. Copper was 434.18, ended at 458.95. A little bit of rethinking on Friday here. So you had the monetary followed by the fiscal announcements. Up 5.7%. Aluminum up 5.5%. Here's the same thing. This was the reaction for the monetary. This was the reaction for the fiscal. Ended at 25.51 from 24.18, up 5.5%. Companies did even better. Look at Freeport, 51.34. This is a 1-week return, up 15.3% for the week. I was long Freeport, and it was dropping, sitting around $40. It ran up to 42, and I thought, well, given the backdrop that we have, let's sell 45 calls against my position, because you didn't have this. You didn't have the central bank. This is what is called an exogenous event. It's not endogenous to the system. It's not a function of supply and demand. It's something else. So I did not anticipate that this would happen. So unfortunately, anything above 45, I don't get to participate. What's the word for that? BHP 6201 up 13%. Rio 7123 up 10.3%. Now I'm giving you this in US dollars, whereas they are listed in Australian dollars. So to get the true percentage, you'd look at them in Australian dollars. Southern Copper 118.87 up 14.74%. Freeport being the big winner here, 15.3%. In the aluminum space, Alcoa up 16%, 39.35. And we have a French aluminum company up slightly, 3.76%. Alcoa up big. Big moves. So the question is, well, you have the announcement and then you actually have action from the consumers and businesses. Are they going to take this up? Are they going to run into the property sector knowing what it has done? Are they going to run into the stock market, knowing that over the last 10 years it's lost a significant amount of value? Yeah, it's had a big run up last week, but take a 10-year chart and look at it. It doesn't look great. How many people have been burnt in the property sector and in the market? Is this going to get them back in there? At the margin, it's going to be helpful. It's all in the right direction, but at this point, it's up to the consumer and businesses to take up the next leg of the journey. I don't know. I don't know if this will translate into action, but the announcements certainly moved markets. Okay, SPY becoming more expensive, not in terms of price, but valuation on a forward multiple. Forward 4-quarter operating earnings, this is the last week for these, and the fourth quarter will fall off, and the third quarter will fall off, and the third quarter of next year will come online, which will boost these numbers because earnings look like this, right? This one falls off, this one gets added. Closing SPX 57.38.17. Ahead of third quarter reporting, you're sitting at a 22.3 times forward multiple. I mean, you're priced in, right? Versus 22.08. And this is what is difficult about buying the market today, is that there are no deals. If you're buying the market, there are no deals. You're paying a premium for it right now, and you have to say, well, does the environment going forward justify a premium? Surprise factor 4.6%. Beginning of the year, it was closer to 8-9%, 4.6%. If we put that into the forward earnings, we'd be down at 21.34 times forward earnings. Implied volatility fading away. I drew a couple of lines on charts here because some people like lines on charts because if you can draw a line, it's predictive, right? So let's draw lines on charts and see what we get. Here is the long leg run up, and then you had a little bit of rethinking about it, and then no, we're doing the right thing, and then you had a little bit of rethinking about it, and well, are we doing the right thing? You have another one potentially going on, and I don't know. I would seem to think that given all the events in the world going on right now, that there'd be some caution being applied, but this is not caution. Money market funds are showing a lot of caution, just increasing week after week after week. The balance in money market, the safe haven, the safe place to be goes up. Gold going up. Market going up. I don't know. One of those moves are wrong. I don't know anymore. Macro's just been a brutally hard play. All-time high, 52.70, reached on September 26th. Earnings for the week, LSEG says 7, Sector Spider says 6. I'm not even going to worry what S&P Global says anymore, but they just can't agree on it. LSEG says Monday, look for Carnival. Sector Spider says I'm not even gonna list it. Tuesday, Nike. And that'll be interesting, right? Paychex, McCormick, and Lamb Weston is Tuesday, according to sectorspider.com. And I confirmed it. It is Tuesday. I went to Investor Relations to confirm it. So LSEG, you lose a mark. I'm not doing too well on your test here. Wednesday, ConAgra, and Thursday, Constellation Brands. So you got some interesting names here. Lamb Weston will be interesting. I think Nike will be the interesting one to look at because, well, it hasn't been doing well lately. Do we see a new life into Nike on this earnings report? And that is it. Oh, one more thing. Tuesday night, I don't think this matters at all. Vice presidential debate. It rarely matters, but I don't see Vance outdoing Walz on this one. I see it getting ugly at times because I think Vance will probably go after him for his statements about carrying weapons in war when he never did. I think he'll go after him for that, and Walz's defense of that was weak, which tells me that he made it up, he lied, he got caught in a lie, and he doesn't know what to do right now. Canada had that same problem with our defense minister, Harjit Singh, where he made up stories about all the things he did. It turned out he didn't do any of those things, and he didn't admit that he lied. It was great how when liberals get caught in a lie, what they call it. He called it a mischaracterization. I mischaracterized my role. I'm going to use that next time. You said you were home all night. You lied. No, sweetheart, I mischaracterized my location. Some of you guys who are in relationships, try that out. Tell me if the mischaracterization works. Does she then say, oh, okay, well, that's different if you mischaracterized. I didn't lie. I mischaracterized. Anyways, I will see you for the live event that is happening in, 7:15 Eastern Time. Ciao.